Welcome back to Financial Therapy. It's not just about the money. I'm personal financial planner, columnist, and financial therapist Rick Kahler. Research tells us that 90% of all financial decisions are made emotionally, not logically. For nearly 4 decades, I've been helping people make better money decisions. So what makes my financial worldview different from most financial experts? I blend the nuts and bolts of financial advice with the emotions that drive making them. Good money decisions are not just about the money. So let's get started with today's episode. Welcome to another edition. Over the past 5 years, I've written a number of columns and given several media interviews on the risks of speculating in cryptocurrencies. More recently, I wrote a column and did a podcast on personalities that tend to invest in crypto. This particular article was the genesis of a conversation with some of my CFP peers about the recent crypto meltdown. And I received a follow-up email from one of them that said, "Hey, Rick, another observation about the crypto meltdown. This article truly stopped me in my track." And he quoted this. Many of the cyber investors, with quotes around investor, that relied on information and peer encouragement through online discussion forums started sharing that they had been wiped out, were losing houses, had lost life savings, etc. Peers started posting suicide prevention phone numbers and begging other posters to hold on a bit longer. And he said, suicide prevention hotlines. Wow. Well, there was an article, which was one of the top posts on the Reddit forum, that said, "I lost over $450,000. I can't pay the bank. I will lose my home soon. I'll become homeless. Suicide is the only way out for me." When I was researching this, I was kind of surprised that suicide over financial stress is not something that I have ever written about in 31 years of writing a column, or certainly the couple years I've been doing a podcast. Yet it ranks as a significant contributor in suicides. And that's according to a professor by the name of Eric Elbegen from Duke University. And in an article that appeared in Medical News Today, he wrote about this and discussed it. It was from September 8th, 2020. I did a quick Google search and I found just a lot of articles on suicide connected to Bitcoin. And one of the headlines was, "My brother killed himself because of Bitcoin." Another Chinese Bitcoin trader commits suicide after losing 2,000 Bitcoin. Another Bitcoin trader, 23, takes his own life after losing all his money to Bitcoin. And another one, Bitcoin millionaire kills himself. Now, these people took their lives rather than face the intolerable pain and shame of losing everything they had, facing the prospect of being homeless, unable to care for themselves and their families, and the deep humiliation of being unable to make good on their promises to repay creditors. The current crash in Bitcoin and other cryptocurrencies, one that lost 99% of its value in just a week, went by the name of Terra Luna. It's just another one of the, what I want to call, financial crashes du jour. It's just a different vehicle, but the same story. We've had a number of similar financial crises in history that go way back. And almost all of them have resulted in people suffering catastrophic financial loss and taking their lives. The most recent, if we get out of Bitcoin, which actually Bitcoin took a pretty good drop. I think it was in 2018, and there was suicides committed around that time, was in 2008, the Great Recession. And there was an article that I found that some research done that said the rates of suicide increased by 5% in European and American countries, particularly in men, and particularly around job loss. So this is common. When I think of financial suicide, I go back to the Great Depression, when in my mind people were leaping out of buildings, killing themselves, and it was just widespread. I started researching that, and I found out that that's basically a myth, that depression just was epidemic. And in fact, Winston Churchill said that he viewed a man jumping, I think it was from the 16th story of a building in New York on September 29th, and fact-finding showed that this gentleman jumped 3 hours before it was known, and that the market had even crashed, that he jumped for completely different reasons. So I thought that was a curious side note. And I think it's important to understand that there doesn't have to be widespread economic, financial catastrophe happening for a person to have a personal financial crisis. All financial crises are personal, regardless of the current strength or weakness in the economy. Even when you're having an economic collapse, not all people are affected. So any financial crisis is personal. So any severe change in a person's finances, like the loss of a job, a major loss of value in investment. Think of maybe around the Bernie Madoff scams, where people who invested with him lost their life savings, or the failure of a business is pretty common, and it's a personal financial crisis. All of these could result in someone taking their life. And I think this is true, that regardless of the specific cause of one's personal financial crisis, the major reason, the common denominator that I see for the severity of that personal crisis seem to be two things. One, being heavily in debt, and or number two, being all in on a can't miss guaranteed investment, with quotes around it, opportunity, or financial speculation. I don't have a percentage of what percent of financial suicides would include those two factors, but my guess is it's really high. To kind of support that, when these recent headlines have screamed about people taking their lives because of the crashing cryptocurrency markets, you haven't seen headlines about people taking their lives because of a 10% decline in their non-leveraged, diversified investment portfolio. I think borrowing is probably the number one factor of a financial suicide. I remember my dad once told me that he said it's a lot harder to lose everything when you don't owe anyone anything. So I really think that being leveraged meaning debt. We leverage when we buy a house, for example. We buy a $500,000 house, and we borrow $400,000 of it. That's an example of leverage. That's an example of very common leverage. And not all leverage is bad. We'll talk about that in a minute. I did find a survey done by the professor that I talked about previously, Elbergen, of over 34,000 adults. And he did it in 2001, between 2001 and 2005. And it was done by the National Epidemiologic Survey on Alcohol and Related Conditions. And they found that being in debt or facing a financial crisis like unemployment or past homelessness and having a lower income were all associated with suicide attempts. And he found that the people who have experienced all of these financial stressors could face a 20-fold higher risk of attempting suicide than those individuals that hadn't experienced any financial strain. Now, a 20-fold increase in attempting suicide is something to pay attention to and to take very seriously. I think it really also emphasizes the spontaneity and the impulsiveness of financial suicide, as opposed to those who have considered suicide non-impulsively for a longer period of time. We're not talking about somebody who's really had a really long-term depression or has fought underlying mental health issues that is suicidal and contemplates suicide for probably non-financial reasons. I don't know what percent of suicide that financial causation attributes to. I tried to find that, but I really couldn't. I know it's in financial suicide is in the top 15 reasons for suicide. But this type of sudden financial crisis that comes along is, I think, underscores the impulsivity, which one study done in Korea found that half of all suicides are impulsive. They're not really thought out. And this is really hearsay and anecdotal evidence. I was speaking with one of my colleagues a couple days ago, and she worked in a mental health organization. And she said she knew of 3 people who committed suicide or tried to commit suicide and failed. And every one of those, she said, like the split second between they decided to go through with it and before they should have died, were regretful, like, oh, I didn't want to do that. Now, that doesn't necessarily underscore whether they were impulsive or not. But I think all of this, what I'm trying to say, that there's a real gravity here in making sound financial decisions. We usually don't wrap them up as this is a life or death situation when we decide to borrow money or we decide to go all in on an investment. But it certainly could be, and it really underscores my friend and mentor's Dick Wagner, his long-held assertion that money skills are 21st century survival skills. And I don't know, he wasn't necessarily speaking survival as staying alive and not committing suicide, but I think he would absolutely say, yeah, that's a part of it, totally. That's what's kind of on my mind, especially around all the crash that's involved in the cryptocurrency markets. So that kind of leaves me then with, well, what can you do? I'm going to the flip side of this and looking at the ways to avoid this. And I think that obviously this is a pretty big topic. Suicide is a big topic. And I'm not going to pretend that I have the data expertise, training to really address such a huge topic. But I think I can offer some suggestions that can be helpful, especially as we're looking at this under a financial lens. Now, the first thing I think is obvious and very logical, which is financial literacy, right? A basic understanding of how money works. Again, thinking of my friend Dick Wagner, who said financial planning can be summed up in one sentence: spend less, save more, and don't do anything stupid. It can be as simple as, well, don't spend more than you make. Only the federal government can print money, which means the rest of us have to borrow money when we overspend our income. And how do we do that? Well, the number one way we do that is with credit cards. Every time you use a credit card, you are borrowing money. And borrowing money, as I've said, is typically the headwater of most financial catastrophes. Now, I said before that not all borrowing is bad. Borrowing for an investment does have its place, but it's got to be done with great care. I don't recommend ever borrowing to purchase liquid investments like stocks or bonds or mutual funds or commodities. And I don't recommend speculations that inherently involve leverage, like futures contract. When you put $1,000 down on a futures contract, you have inherently borrowed $99,000, or they're highly leveraged. Or buying stocks on the margin, where you have to put down 50% to buy double of what you could have bought in stocks. Or options. And option strategies are inherently leveraged. This is where you can lose. When you think of leverage, it's when you can lose more than what you put down. So if you put down $1,000 and can only lose $1,000, then that's not leveraged. But if you put down $1,000, as I did once on pork bellies, I don't think I've ever told that story on this podcast, and I lost $12,500. All right? That's a speculation. That's leverage. Now, things that people will typically borrow for that can be sensible borrowing can be real estate and some business opportunities. And there's books and there's articles and there's all sorts of stuff. There are my articles where I've talked about in depth how to borrow sensibly on these investments. Definitely, wealth can be made through the proper use of borrowing, but it must be done very consciously and with a lot of contemplation and due diligence. Of course, there's the old adage, don't speculate with more money than you can afford to lose. That's such a trite piece of advice that I don't think that we often pay a lot of attention to it. The problem is knowing what is a speculation, because we call these investments, right? I've talked about this before. There's 3 ways of accumulating wealth: saving, investing, and speculating. And a lot of people go from saving to speculating, get burned, and then say, I'll never invest again. An investment is typically really boring. It's typically very long-term, and there's the hope for a modest return. For example, you're probably investing. If you're hoping over the long term, you can earn 5% a year. A speculation, on the other hand, is usually very volatile, has huge swings in it, has a lot of emotional intenseness, and it's a short-term hope for an exponential return. We're not talking 5% a year hope. We're talking 50%, 100%, 500%. I had a client once who had borrowed and put $50,000 into cryptocurrency. And the plan was to sell it when it hit $500,000. A long-term investment of 5% on $50,000 would have been $2,500 a year, right? So there's usually a big difference in what we're hoping for. So we want to avoid speculating. We want to avoid putting any significant amount of capital or borrowing money to do so in a speculation. But logic isn't helpful, all right? And I try to stay out of logic on this podcast. And if you find yourself still compulsively speculating with a compulsive financial behavior of risk-taking, then it doesn't matter what the logic is behind the advice. Everything that I've just said is meaningless when we still have that compulsion to roll the dice on a speculation, whether it's real estate or business or cryptocurrency or stocks or whatever it is. And the more that you listen to yourself and the parts of yourself that want to make these highly risky investments that they may not, in many cases, they don't view them as risky. If you hear them saying, you can't miss on this, this is a sure deal, this is guaranteed. If you hear those thoughts running through your mind, I would suggest the more alarmed you have the right to be. But listening to advice like this usually is not going to help. What we need, what's going to change that behavior is to speculate, is understanding that it's not a calculated financial decision, which we can lull ourselves into thinking, but it's really a deep emotional wounding. Most personal financial crises have their roots in emotional wounding and trauma, especially those that come from being over-leveraged or being all in, being undiversified. So it looks like, the real issue is a poor financial decision, but that's just the tip of the iceberg. The underbelly is some type of underlying trauma and unresolved emotional pain. So until this is gently and curiously uncovered and resolved and healed, the speculative behavior is not going to stop. I want to say this, that if you have an urge to take your own life, it is a clear sign of the depth of the emotional pain that you're in, even though that may not be conscious. Poor financial decisions have a cure. When we take the emotions out of them, there is typically resolution. There's ways to right the ship. But that's not something, when we're in deep emotional pain, that we can see or that we can believe. And I think I've said this before on the podcast, but with an IFS lens, we know that when we're contemplating suicide, this is a manager and impulsively, definitely a firefighter that sees that the pain is so great for this emotional part of us that's been exiled, that's been blocked off, that's so vulnerable and so hurting, that there's really a good intention here of wanting to soothe that pain, of really wanting to put that part of us that is hurting so badly out of its misery. And it's the same action of a firefighter that will turn to alcohol or turn to drugs or turn to work or turn to any more addictive type behavior. It's always with a good intention of putting us out of that pain. Suicide is just the ultimate medicator, right? All of those other things are medicators. Suicide's the ultimate medicator. So this can help. I think I've discussed this with people that have attempted suicide or had loved ones that attempt suicide, to kind of reframe this, that we're not looking to get rid of this, quote, destructive part of us or make it wrong. We want to understand the reason why this part of us wants to do this. What is it protecting? What's the part of us that's in so much pain that it feels just so hopeless that it will ever recover. And ultimately, if we can take a look at that, and if we can be able to get those protectors to step back so that we can listen to those parts of us and hear that, we can really heal that deep, deep pain. So that's the best thing, I think, when you are aware of being hooked in a hurtful financial behavior, going all in, speculating, borrowing, is to get curious about the pain that underlies the behavior. And again, if you hear yourself saying you're not in pain, that's probably a really good indication that you're in a lot of pain. But it is just really buried and being medicated, especially with all the risk taking. So, as usual, it's really important for us to ask for help, but this can really save a life. And a therapist or a financial therapist can go a long way to guiding you to discover the core of the pain, the core of that behavior, and really help you to heal those parts. Thank you for listening, and I look forward to being with you again next time. Thanks for joining me, Rick Kahler, for another episode of Financial Therapy. It's not just about the money. This is where I combine the nuts and bolts of financial advice with the emotions that drive making them. Remember, every financial behavior, whether it appears illogical to you or others, makes perfect sense when we understand the underlying beliefs, feelings, and thoughts. Sign up for my weekly blog at financialawakenings.com. I hope you'll join me again for our next episode.